QuantSpeak, expert insights from quants for quants.
Welcome to QuantSpeak, a new podcast from the CQF Institute at Fitch Learning.
Hi, I'm Dan Tudball, editor of Wilmot Magazine, and this is QuantSpeak. I have found myself tilting at windmills on more occasions than I care to enumerate, so it's rather nice to be able to introduce this edition with a quote from Cervantes. "It is the part of the wise man to keep himself today for tomorrow," says Sancho Panza, "and not to venture all his eggs in one basket." Which actually isn't a quote from Cervantes at all, but a whimsical, by which I mean wholly inaccurate, translation from the 1700s by one Peter Moteur, a London trader in wares from India and South China, alongside his career as a literary cavalier. So much for eggs then. But as evidenced by Monsieur Moteur of St. Mary Axe's motley means to monetary ends, the unreliable translator did at least believe in diversification, which rather neatly is today's topic. As Cervantes also once maybe wrote, in order to attain the impossible, one must attempt the absurd. Today, I'm joined by Jean-Paul Jaegers, head of asset allocation at Barclays Wealth and Investments. Jean-Paul's career in tactical asset allocation and multi-asset solutions has taken him from risk-taking as portfolio manager in an absolute return macro fund to a role as senior multi-asset strategist for one of the largest insurance companies, and now to leading a team of experts in private wealth for Barclays UK, covering both strategic asset allocation as well as tactical asset allocation in the wealth business. Jean-Paul will be giving a talk for the CQF Institute on 9th of November entitled, "Tell me, what exactly is diversification and how do we evaluate it?" Welcome, Jean-Paul.
Hello, Dan.
Thanks very much for joining us today. Now, I wouldn't normally refer to current conditions on this podcast, but the markets had quite a ride after the now retracted mini budget in the UK. Global markets are seeing a regime shift, getting back to reality, you might say. It'd be good to get your take from an asset allocation perspective.
Hello, thank you for the nice introduction and the welcome words. And as you say, it has been quite a time for financial markets. I think there are a few observations we can make. So it's again a good practical example of how politics is very difficult to use in investment decisions and market timing, especially when we have an asset allocation mindset. And one of those reminders that exogenous shocks and events will come and go. And in that respect, we've seen the volatility in the gilt markets has been phenomenal. In the extent, but also in the pace that surprised many investors. And I think this actually ties in nicely with the beginning of your introduction, diversification. That diversification in investment portfolios is to reduce or isolate those kind of impacts in a wider investment portfolio.
Absolutely, yes. It's been pretty hairy recently. But diversification is a word that crops up in a lot of brochures and investment philosophies, but it's often used interchangeably with efficient or optimal in a very naive, pure risk-return lens, isn't it?
Yes, that's a very good observation. So I have the impression very often when we read about investment philosophies or if investment teams explain how they build investment portfolios, that very often they use the terminology diversification and maximum diversification. And very often, if you think about it, I think what they implicitly try to tell is that they use a portfolio optimization technique. And it's important to differentiate between the two because diversification is, of course, much more than just having an optimal or an efficient portfolio. I'm going off a little bit on a tangent here, but it's interesting. In the early 2000s, some researchers at Yale, they came up with an experiment and asked people to explain something of everyday life. And they said, can you please explain me a house or a zipper or a rainbow? And beforehand, he asked them to rate their knowledge. Then he had their students explain the concept and didn't stop them. and during the process, ask them to rate their knowledge again. What often happened is that when explaining something, they start to realize they knew much less about it than when they started off at first hand. And that's a little bit what they coined the illusion of explanatory depth. And I think one of the words that really reminds me as a good concept for this is diversification. We hear it a lot, we read it a lot, but once we really test ourselves to, can you really explain it in length or detail? How far can you go? And I think that's sometimes a good test, because very often people start off with portfolio optimizations or efficient frontiers, but then very quickly it stops.
Exactly, and that's a problem that I find if I stop to think about it, I have absolutely no idea what I'm talking about. So you mentioned portfolio optimization, efficient frontier. Depending on what measures you use for diversification, the efficient frontier and the diversified portfolio could be located in entirely different areas.
Yeah, yes. So often at university, or people get educated on finance, then you get the concept of the efficient frontier or portfolio optimization. And very often, if you illustrate an efficient frontier, people immediately look to what's the global minimum variance portfolio, or where's the tangent on the efficient frontier, and think that that's the best place to find a diversified or an asset allocation for a portfolio. But if you think about it, back decades ago, we came up with portfolio management techniques to reduce a very complex problem. So often it has been reduced to one or two dimensions, where obviously some crude assumptions had to be made. And everyone was aware of the time that if you just look at volatility or return, that you can come up with a better way of come up with an asset allocation instead of 1/n. But of course, those come with quite crude assumptions. On the efficient frontier, or even below the efficient frontier, there will also be very concentrated portfolios, especially if you go up the risk spectrum or down the risk spectrum. And the question is, if you have very concentrated portfolios, is that still a very diversified portfolio? Or if you are more holistic and think about more than just risk-adjusted return, investors would have preferences for upside versus downside. So then you start moving away from the single point estimate you find on or below the efficient frontier. And I would probably argue that if you think about diversification as a more holistic concept, that your diversified portfolio could be anywhere below the efficient frontier. We don't know. So it depends on the dimensions you start introducing, that you start moving around below the efficient frontier, where the asset allocations could actually look quite different. But once you introduce drawdown, permanent loss of capital, those kind of considerations, you might actually move away from the one or two dimensional world.
Absolutely. Before we discuss dimensions a little bit more, when you were at university and experiencing finance for the first time, how were you struck by portfolio theory relative to your understanding of diversification? And we'll get on to how that perspective may or may not have changed over the years later on, but we'll follow up with dimensions. But I'm just interested to note, where you were at university level and whether you think there's any learnings that we might draw from that in terms of the assumptions that people make.
That's a very interesting question. So when I did my university degree, which I thoroughly enjoyed, and that's where I discovered my passion for investing, very often I think the nuances with a lot of theories come with the experience you get over time. So very often when you get thought about modern portfolio theory, or how to optimize portfolio, or how to think about risk management, in at least during my education, I always felt, well, those are some very helpful solutions to a problem. But with more experience under my belt, I felt, well, there are a lot of nuances and crude assumptions which probably I didn't realize to the full extent at that time.
Right. Yeah. So going back to dimensions again, you're talking about more than one or two dimensions. Let's say, more than just variance or risk-adjusted returns matter for investors or portfolio management. Can you add a little bit more to that observation?
Yeah, of course. So it's that I think in the industry developed quite some decades ago. So if you think about portfolio management, very often then it came up about optimizing a Sharpe or optimizing a utility. And by doing that, you're able to reduce a complex problem into something that has one or two dimensions, and you come up with an optimal portfolio if you only look at that measure. But of course, we know that volatility as a risk concept is actually quite, one could say, naive or limited. If you think about loss of capital, or if you get upside volatility. So in some sense, you could say, well, it probably investors differentiate between upside risk and downside risk differently. They will perceive and feel it differently. And that goes back to the Kahneman and Tversky observation of prospect theory, that losses actually feel much more painful than marginal gains. The same, you could think about what's another way of getting more convexity or skew in portfolio. So if you have something that does well if markets go up a lot, or if markets go down a lot, but might not lose too much in the middle. So you could think, for example, at trend following models or ideas. So those are ways, I think, to enhance or to improve the profile of a portfolio and move away from necessarily getting volatility. Because if you would purely think about a more plain vanilla Markowitz efficient frontier, you could possibly argue if something is imperfectly correlated with your portfolio, and with imperfectly correlated, I mean having a correlation of exactly one or -1, that as soon as you have something that's imperfectly correlated, you can improve the diversification of your portfolio. But sometimes implicitly you make a trade-off in other characteristics or elements of your portfolio. So it could be that if you include an asset or security that's imperfectly correlated, that actually your downside risk increases. So you might get your optimal Sharpe up a little bit, but you introduce another dimension which is not captured by your Sharpe, which might create a more negative impact on your portfolio. And that makes it quite hard, because if you think, well, I want to optimize the best risk adjusted return with the minimum drawdown risk, with the best skew convexity profile, with the best, and you can layer on as many dimensions as you like, the problem becomes actually very complex, and it's almost impossible to optimize in so many dimensions. And that's why often it has been reduced to one or two dimensions, and you could either prefer a utility or a Sharpe or whatever you pick in that sense. But the importance, I think, one of the reminders we have in as practitioners is to think, well, that's one way of optimizing your portfolio, but potentially you could bolt on different nuances and different perspectives. And even if you find an optimal Sharpe, well, how do we assess the drawdowns and compare the drawdowns of the different portfolios? How do we look for different upside compared to downside?
As you're saying, the question is, how much would you give up from this optimal tilt towards something else? And, I'm thinking, you mentioned that it was actually trading that really got you interested in finance in the first place. Do you have to have a trader's mindset to think about diversification in an effective way, rather than just a technical mindset?
I would probably say it's more curiosity in understanding of the technicalities, and the curiosity to question your own understanding and how things behave. I think the curiosity is probably the most important element that I think got me started in finance, and got me so absorbed in investments, finding out new ways, and where often in building portfolios or trading derivatives or pricing, it can get quite technical. So that's the technical curiosity. But equally, on the other hand, if you are in asset allocation, it's very macro oriented. A lot of things in macro world are not Gaussian, and especially not as precisely modeled as we often see on the derivative side. So especially on the macro side, a lot of the models are very crude and raw, and the data doesn't allow for very precise modeling. And also there you have the curiosity of why does this economic model work, or why does this happen if central banks raise or lower policy rates. And I think it's more the curiosity that will keep you sharp as an investor, and keep you sharp on why are things happening as they are happening. How might things be different in the future compared to the past? And I think what we see now is also a very good reminder of that. We started at the beginning in a conversation touching on diversification, but actually this year is a very good reminder, possibly for a lot of multi-asset investors, that they have spent a lot of time on optimizing or thinking of introducing diversification in their portfolios. But at times like these, where equities have a severe drawdown, fixed income has a disproportionate drawdown, credit is down year to date. So although you thought you had a lot of diversification in a world of elevated and increasing inflation, it didn't turn out to work. And then getting back to your initial question of how much would you give up when you tilt your portfolio if you start introducing more dimensions, well, that's often the hard bit. And we see that a lot with a lot of models. If you have to come up with a risk aversion parameter, or if you need to come up with exactly how to get to the nitty gritty of the parameters, that's quite difficult. So one could think of, if you come up with a portfolio asset allocation based on a certain optimization technique, that you could start introducing or look within the efficient frontier to look for slightly different allocations that address those other dimensions that were not captured in the initial optimization technique. But how much of a sharp would you give up, or how much of utility would you give up to move around in the frontier is more, I would probably say it's more of an art than a science, and it would probably also depend on the allocations themselves. So for example, if you would have a very concentrated portfolio, you think that, well, that doesn't really fit with being very diversified. Well, to what extent are you going to rebalance or reshift your portfolio to get something that looks more diversified or has more properties? If you look to downside, upside, and that's more of an art than a science. And I think that will depend a little bit on the type of portfolios. That will depend a little bit on the lenses being used, because most of the times we talk about portfolio weights, but you can also look at factor exposures. So a lot of different ways how you can slice and dice your portfolio. But I think it's just the observation that if you have come up with a portfolio allocation, you could still consider or think of additional steps to address different dimensions. Very often I have the impression that if investors come up with a portfolio allocation, that they will say, well, this is the optimal I get to, and then use terminology as diversified to refer to that product. And I actually think, well, diversified is much richer and could include more dimensions, but it's not as precise. And the purist would say, and that's a little bit with the modeler hat on, the purist would probably say then it's not optimal anymore. So you're not optimizing to something specifically. So if you do portfolio optimization towards something, you get an optimal in the sense that you can define it and write it down. If you start mixing or tilting towards slightly different techniques or different dimensions or considerations, essentially your portfolio is not optimal to one dimension anymore. That would probably be the pushback from the purist.
Absolutely. I guess the lesson is just not to fall into the trap of being blinded by a narrow definition. So, Jean-Paul, although there are complex techniques to address some of the known weaknesses like covariance matrix shrinkage, but why is it that too little reflection is likely given to the trade-offs and how to balance multi-dimensions? Why is that?
That's an excellent question. And to be very honest, I don't have a very precise answer to that. So we have seen a lot of advances in different techniques, so in risk management, in portfolio optimizations. But if we think more holistically about diversification, I don't think there exists a broadly accepted, unique, satisfactory methodology to quantify and to manage diversification. And I think part of the problem is what we touched upon a little bit earlier, is if you have multiple dimensions. So very often, if you read some of the academic literature, they come up with comparing the sum of standard deviations with the standard deviation of your portfolio, or they will look at some concentration index, or they will have other measures that aim to measure diversification. But obviously, that's then getting back again to either a volatility or a weight concentration measure, as it is just very difficult and very challenging to get the different dimensions layered up in a way that you can really measure it and quantify it. And that makes my life sometimes a little bit harder, because if senior management at Barclays says, well, Jean-Paul, you're always telling us about diversification and that we should not just look at a risk-adjusted return or an information ratio, that it includes much more than that, then it's very difficult in some sense to really quantify that. So to quantify what's a good asset allocation, and has this asset allocation been excellent or just okay? How close has it been to the modeled or your expectation? And in that sense, it's quite a difficult measure to grade or to measure in a quantitative way. How good has your diversification been?
Generally, in your conversations, wherein the crux is that point, what's the shared definition of diversification, and making the assumption that all agree it's not just risk-adjusted return. How often do you find yourself having sort of different iterations of the same conversation to get everybody on board?
So that depends a little bit on the counterparts, how well or how deep he or she is involved in investments or had investment background. And as there is no broadly agreed or accepted satisfactory way to really quantify or manage it, it remains a live debate. And that is a little bit the challenge, but also a little bit the beauty. We keep educating ourselves on how to look at portfolios in slightly different ways and how to get slightly different perspectives. A good example is sometimes when I get questions either from clients or from various parts of the business to say, well, if you have a multi-asset portfolio, you have a range of different assets in your portfolio, there will be an assets that will have a poor return over the last year, over the last 3 years. And then it's very tempting as humans to look at where are the losses in your portfolio, and then start questioning, why do we still have it in there? Should we not change something? Why has this been introduced in portfolio? And then very often it gets a little bit philosophical or academic, but then I'll always explain, well, there are many counterfactuals. And in some sense, you care and should care about the profile of your portfolio, because in any portfolio, there will be winners and losers. And if you rank a portfolio versus assets, by definition, a diversified portfolio will not be at the top or at the bottom. And that's something I think, it's often that emotions come into play, or that our minds get hijacked a little bit to look for certain losses or way to improve a portfolio, which often can be a bit naive. And where I think the important bit is in the messaging is look at the total portfolio, assess the properties of the total portfolio, and see whether that fits. And just keep in mind that that's one realization of the past of many counterfactuals.
That neatly leads on, considering what considerations one could make when building portfolio allocations. What are your thoughts on that? What are your thoughts in terms of industry standards and other ways in which we might be able to kind of get beyond a narrow view?
So I'll touch on that in a little bit more detail in the talk on November the 9th. But if in industry standards, so a little bit during this podcast, we spoke about some of the limitations in diversification. It's hard to being defined and very hard to measure and to grade in quality. But then the question often comes up, well, it's nice to label the problems, but can you also come up with some solutions? One of the things one for example can carefully look at is, instead of starting off with an asset universe, so if as an investor you get given an asset universe and say, well, let's come up with an asset allocation, or how would you structure this portfolio, is to carefully think of how you would group or partition different assets. So I think sometimes there's a little bit an overlooked step in a lot of asset allocation questions, that once you get a universe of assets, that you could group the different assets or partition the securities. In that sense, you address a little bit of the potential correlation risks you might have. So if you group certain assets that have a high intra-correlation and just say, well, this is one asset, and then you have another group of assets and you say, well, this is another asset. You can think about clustering techniques, a lot of quantitative techniques that will help you in splitting up the data and making that your starting point actually is potentially a little bit more robust than starting off with just all assets in one group and letting a portfolio optimization pick and choose the weights to those assets. And other common industry technique we often see is bootstrapping. So we see that just a way of resampling the past, and actually by resampling the past many times, you allow yourself to create a lot of different potential futures. So we can use historical returns and use that to create potential futures. But a little bit what will happen is if you sample a lot of your past returns, that's the central limit theorem coming to the rescue, you get something that looks very Gaussian. And as soon as you have something that looks very Gaussian because you did a lot of resampling from the past, that will depart from what we see empirically, and especially in macro, where a lot of assets and a lot of investment vehicles don't behave in a Gaussian world. So what you could think of, for example, is think about block sampling or probability sampling. So you sample something from the past, but introduce a little bit serial correlation by saying, well, what's the probability you actually get the realized next month or the next realized month? And by that, you get something that's in between the empirical distribution and the Gaussian distribution. So you introduce something that has slightly fatter tails and is a little bit closer to reality. And once you come up with, whether you do that with a Sharp or with a utility portfolio, what you then can do is, as we touched on a few minutes ago, is say, well, how much do I give up to tilt it to somewhere else? So you could think of, once you've done one optimization, to allow a certain budget of the where you optimize to do a second optimization, or to do an interpolation or do a tilting to slightly different portfolio that either addresses concentration, that either addresses downside risk, that would improve the skew, those kind of examples. And I think those mixes and matches is probably where a little bit the uniqueness comes in, where I think often the asset allocation process stops when we get to an efficient or an optimal portfolio.
Certainly, I can see where, say, something like machine learning and synthetic data would come in very useful in that sort of scenario.
Yes, absolutely.
You know, the sort of delineation that you mark there between micro and macro is also very interesting. I mean, it's almost as if macro is the wild frontier, and you're out there.
It is true that within macro, often the models are a more crude simplification of reality, and often data-wise, for macro data, it's much more challenging. And that's part the beauty, but also part the challenge. If we think about pricing derivatives, and a lot of these subjects come up during the CQF, then in the continuous world, we can recalibrate models. We can do converge towards something. And actually, if you do it in the continuous world, you get something that does a pretty good job. As soon as you step to the macro world and a lot of economic models, then suddenly the data is not coming to the rescue, and a lot of it becomes, because you use discrete time frames, and then suddenly it becomes much harder to model something, or to get a model to converge, or to get something that's very accurate. So in the macro world, the models tend to be a more crude simplification of the reality.
Absolutely. And as a result, a lot of opportunity there, I would imagine.
Yes. So I think, and that comes back to the point earlier about curiosity, that it's more about questioning the limitations of what you're really modeling and how that impacts the output, and that you should stay focused on, well, especially for some of those models, it's a very crude simplification. How in practice, or how does the practitioner adapt to that? How can we make sure we are aware of the risks in portfolio or the downsides of different optimization techniques and the limitations? So that requires, a bit more active, I think, reflection and curiosity, and probably over time experience will help with that.
Fantastic segue to the next section of the discussion, because we're going to spend a few minutes now talking about your career. And curiosity, of course, leads to the first question. What was it that led you to a career in finance in the first place?
Oh, that's an excellent question, and I have to go back far in time. So I think it was during my teenager time. During my teenager time, I really didn't understand if I saw on the news or read in a newspaper that stocks were going up one day and down the next day, and that really I couldn't get my head around that concept. That led to me starting reading books. So I started reading books on stock pricing and on option pricing. And I still remember then I was a student, so I had some savings from a student job. I was not able to sign any documentation, so I had to go to my parents to sign the documentation for me. But I opened an account to trade some stocks and some options. But that was purely for an educational purpose, and that was purely to learn from the experience. And with the books in hand, try to make something of it. Of course, that was not very successful, but I think it triggered a curiosity and a sense of small passion for trying to understand investments. Well, after that, I went to a business school to study economics, and during this time, I spent some time in Singapore for an internship. And after that, I did a master's in finance at Maastricht University, which I thoroughly enjoyed and really discovered the passion for investing. Whereafter I joined the asset management industry in macro asset allocation and have been since.
And your first gig as a portfolio manager began during a booming market, and it took you through the first years of the last global financial crisis. So that must have been extremely educational.
Yes, indeed. That's one way to put it. It was very, very educational. God, and if I can still vividly remember the various announcements and the sheer panic in markets, but also on the floor, and that makes a very big impression. At the time, we were a multi-asset solutions team, managing around 30 billion in TEA overlays for institutional clients. We had about 5 billion in absolute return funds as a team. And suddenly you realize you have to deal with very different problems than what you're used to. I remember having discussions in the team on cash balances that various of our clients held with banks and custodians, given banks were failing one every time. Questions on illiquidity, so we were not able to trade certain securities or derivatives, which was something that I hadn't experienced before. There were discussions about unrealized P&Ls on OTC derivatives. For example, if you have swaps with Lehman Brothers and Lehman Brothers went bankrupt, what will happen to that unrealized P&L, to that claim? How much can be recouped? And even you saw suddenly afterwards a market opening up for trading those claims. Credit impact, if banks get downgraded, how does it impact if you novate an OTC derivative, and how does it impact? So suddenly we had to put up with all kind of new problems and challenges, which was, as you put it, very educational, and in that sense, a very special period. As a team, we had the benefit that we could fall back on a very robust investment process, because during those times, it's often the trick a little bit to fight your emotions. Very often we humans tend to become indecisive or become a little bit uncomfortable if you have losses in portfolio or how to manage a drawdown, and where you have to stay focused and keep your rational hat on. And I say rational with in between brackets, because it's not that the opposite is irrational. But in that sense, yeah, we were, as a team, we were very involved in the shaping of the investment process and the risk management. And I think as a team and me as an individual have learned a great deal from that. And it's, yeah. Now you mentioned it's actually quite extraordinary that with the hindsight, you don't really feel the panic of it. Now, if you think back of nationalization or failures of banks, it feels less extreme than how it really felt at the moment. In the moment, it felt like there were real concerns of the financial system collapsing.
Absolutely. Again, it really marked a regime shift at that point. In a funny sort of way, we're returning to what it was pre-global financial crisis, just in terms of the macroeconomic situation. I mean, obviously, we had zero rates just prior to the collapse of Lehman and the subprime crisis and so on. But certainly, in terms of that sort of high watermark prior to 2007, 2008, and then what we are subsequently have become very, very used to in terms of the regulatory impact on the markets, that everything can be solved via quantitative easing. And now finally we see, what is it? Quantitative tightening.
It's yeah, it's a very good observation, and I think we still see some of the shadows of the great financial crisis, and you touched on regulation and other elements, but also on some parts you see a little bit the mirror image, or what's the right word? You see a repeat, but then in opposite direction. So very soon after the great financial crisis, all central banks said, well, we get into a period of disinflation, but it will be temporary. Our models tell us that inflation will pick up and we're going to do what we can to raise inflation. Well, it turned out to be a decade of disinflation. And in the process, they gave up on the models to say, well, let's now get more to become data dependent, and they came up with all kind of conditions on what the data need to look like for them to do something slightly different. If you think now about the recent past, is a little bit what we see in opposite directions. So inflation has surged getting out of the pandemic, and central banks told us, well, this will be transitory. Well, that term has been designated to the bin. And now they're turning more to, well, let's be data dependent. Let's see how the data looks like. Let's see how the labor market adapts to it. And I think in that sense, we see some similarities by getting more short term and doing what we can to impact inflation, but in the opposite direction.
Absolutely. So from an asset management perspective, how would you characterize that last decade? Because you went through that nightmare scenario, and then, as you say, this 10-year wait for inflation, and and now, in the great words of Yoda, are you having to unlearn what you have learned?
But yeah, yeah, I think that's part what makes macro so interesting and so intriguing. So we're always changing in environment or regime, and you can think about it in very different time scales. But I think what we have been going through in this since the 90s or since the 80s up to now is, if you think in big picture terms, extremely interesting and also extremely different. I think the current environment, you can't really compare it to the 90s or the 2000s for various different geopolitical and macroeconomic reasons. But also, if you think back about the asset management industry, it has changed massively compared to casting your mind back 10 or 15 years ago. Just a few trends that we have been seeing is focus on risk management. I think risk management has become more to the fore and has improved even further as an important element in asset management. We've seen a massive squeeze on fees. So we've seen a lot of asset managers and wealth managers trying to create scale with the help of technology, and thereby reducing the fees that can be charged, partially because what you mentioned was the lower return environment and low interest rate environment, that high fees would be very hard to absorb for customers. We've seen the importance of ESG and impact investing come to the fore. This is clearly a trend we have been seeing in recent years, that will continue. Very different than 10 or 15 years ago. Also, I think in terms of transparency, if you think about communication, that previously, if you were a fund manager, you were managing an NAV or you were part of a house view within an asset manager. Now investment teams come up with blogs, they have LinkedIn articles, they have videos. So the people who really manage your investments, I think there is a different way of communicating and providing transparency to your end clients. And you touched on regulation. If you think about MiFID, so the relation between investment banks and asset managers, the evolution of the different securities. So earlier on, I mentioned, for example, when Lehman went bust, that for OTC derivatives, you had some unrealized P&Ls and some claims in portfolios and not sure what to do with it. Well, nowadays, those, for example, swaps get cleared. We clearly see, year from year development it's quite impressive if you would cast your mind back 10 years ago, how different the asset management industry looks like, I think.
Absolutely. Well, my last question for you is, if a person with a very quantitative approach to things is looking to progress career-wise in terms of asset management, what would your advice be to them?
I'm a strong believer in continuous learning and using the strength of general curiosity. And it could be either quantitatively. So of course, people who have a quantitative mindset, it's easier to progress and get more comfortable with different concepts or different depths of knowledge in the quantitative side. But I think it's equally important to look for breadth and see how you can learn about things that might not be directly in your comfort zone. And actually, if you have a broad profile where you're very comfortable with the numbers, where you understand how derivative works or portfolio management techniques, but equally understand the limitations or the macro world or how the past may look different than the future, I think that will be a strength to any investor or any individual in asset management, because very often people feel more comfortable in one small area, but I think it's often the trick to become a little bit more broader and just use your curiosity to ask a lot of questions that you can learn at any age in every area.
Thank you. So anything that you'd like to add before we wrap up?
So one of the other things I would like to touch on is that you spoke about experience or what would help you progress in finance or asset management. One of the other elements I've, in my experience, noticed that is an important quality is communication, and sometimes that get overlooked, especially with people like myself with a heavy quant mindset. But the ability to communicate with different stakeholders and different audiences in different language is actually a very important skill set, I think, in asset management. Very often you get stakeholders in front of you who might not be technically have the same background, so you need to explain concepts very easily. Very often you will notice that that's much harder than you initially think it is, but equally to communicate in environments where you need to keep control of the direction of the interview. For example, if you have media interviews or you get questions which you would like to redirect or questions that you would answer in a slightly different ways. And those are skill sets that are often not taught at university, but will come in handy when you get a career in asset management. And that's part of the breadth skill set where someone understands really the numbers, can communicate well, and equally understands the investments.
Thanks very much, Jean-Paul. So we're going to wrap up here. I just want to remind the listeners, CQF Institute ties in with what Jean-Paul was saying about lifelong learning, by the way. CQF Institute, Jean-Paul will be doing a talk on 9th of November. And that is, tell me, what exactly is diversification and how do we evaluate it? To attend is free. You have absolutely no excuse. So we expect thousands and thousands of people to be watching Jean-Paul. Thanks so much for your time today, Jean-Paul.
Pleasure to be here. Thank you.
Thank you for listening to QuantSpeak. Don't forget to subscribe and do sign up to the CQF Institute for more insights into quant finance.